This is InvestTalk. Independent thinking, shared success.
Hey, love the show. I was trying to reach Justin or Luke. Got a question for you guys. I hold a stock. The ticker symbol is NXST. That's Nexstar Media Group. It's a diversified media company with television broadcasting, television network, and digital media assets. It seems that the dynamics are changing. Should I try to reinvest? I would greatly appreciate if you could look at the fundamentals of this company, and I look forward to hearing your answer on the show. Thanks. Bye.
All right, looking at Nexstar Media Group, NXST is the symbol, and this is a name that we actually used to own for clients. We sold it, did fine on it, but it's been a name that's been kind of very choppy for the better part of 3 years. So that was, part of the reason here. It never was able to gain momentum and has a positive yet choppy earnings history. It's up and down. Now, what do they do? It's the largest television station owner and operator in the United States with 200 stations in 116 markets. So think of the local news station that you have that you're on cable, and they have typically a CBS affiliate, a Fox, an NBC, an ABC, that channel that you have in your local market. Well, Nexstar owns that channel, and they do deals with these with the cable companies to have those on their platform and their packages, and they obviously partner with Fox, CBS, and the like. They also have some online platforms. I believe News Nation is one of them. That's a cable network, excuse me. I know they have, I think The Hill is one that they have online on YouTube. So they're fairly well diversified in this space. Not a huge company, $5.5 billion market cap, so not small either. But they do have a decent amount of debt, about $6.5 billion in long-term debt. That has been coming down because they do produce some pretty good cash flow, about $1 billion in free cash flow, which based on their market cap is about a 20% free cash flow yield. The problem is that they have the debt. So a lot of that cash flow is going towards the debt. Earnings are expected to be down 39% this year to $12.98, but bounce back next year to $26.09. Why is that? Simple. Elections. So they made a lot of money last year, $21.41. They make a lot of money off of election ads. And this is a year where there aren't many elections. So it's an off year, and next year is an on year. So that you kind of get that back and forth nature. Even years, it makes good money. Odd years, not so much. So you kind of have to, let's say, level that out over time. And it's still growing its earnings generally. So, I think it's fine for me. We just found better opportunities. We didn't hate it. We thought it was a good company and good capital allocator, buying back shares, has a decent amount of debt, but we think that cash flow is, while up and down year to year, is generally trending in a positive direction. So no issue with it. For us, it just, like I said, a better opportunity. So I'm going to give Nexstar a thumbs up. Now, every day we receive questions from the comment section over on the InvestTalk YouTube channel. Here's one that came in earlier. Jesse Columnero says, I really enjoy your weekend videos and congrats hitting 8,000 subscribers. I have questions that hopefully you can answer on your podcast. What sectors do you feel will do well in the second half of 2025? Well, this is that's always a tough thing to handicap. What sectors are going to lead, which sectors are going to lag. Let me pull up the second quarter. So tech did very well, and a lot will depend on how liquidity dynamics evolve. Like I said, I think liquidity will ebb generally in the back half of the year due to the corporate bond refinancing cycle, and a Fed will likely lower rates at some point, but I don't think that will counteract the draining of the refilling, of the Treasury General account. That's one reason why the market has rallied so strongly, is the Treasury General account has been wound down in an aggressive manner because of the debt ceiling. And so once that's passed and the debt ceiling increases and the Treasury issues debt again, that's going to pull liquidity out of the system, and that ultimately tends to hit the tech industry the most. Now, what was down the most in the second quarter? Well, energy down 7.4%. I think that could have, especially I do think they're going to see more issues in the Middle East. I think you'll get spikes there, but ultimately, I think there's a lot of uncertainty around CapEx and the cost of capital and the deployment of new rigs. And so I think energy is going to have a good back half of the year. What else was down? Healthcare, I think it's a bit oversold. So I think you get an oversold bounce in healthcare. I don't love that space in general. So I'm not going to put my hat in that ring. I do think industrials are going to continue to do well, mainly the weak dollar. Even if the dollar strengthens a little bit, I think eventually it rolls over, makes new lows by year end from where we're at today. And that helps the industrial space. It makes our products more competitive. And frankly, if President Trump wants to achieve his goals, part of what he's trying to do is going to require a weaker dollar. Now, 10% is a good way of getting there. But frankly, you need far more. You need another probably 20, 30% drop in the dollar before our products become more competitive. Issue with that is if the dollar drops another 20, 30%, you're going to really see inflation spike. And I do think inflation will accelerate in the back half of the year, back above 3% from the mid twos of kind of where we're at now. So I like industrials. I like financials. More subsectors of financials. So, the problem with the financials is there's a lot of different types of financials. So I much rather own like the banks. But I do generally like financials. Materials. I think materials will continue to do well. Gold and silver, even copper is breaking out. Some of the industrial metals are breaking out. I really like that space as well. And then lastly, what's the second one I want to give you? A third one I want to give you. Yeah, I would say industrials, energy, and basic materials. A lot of that has to do with the weaker dollar. Let's go talk to Sammy in San Francisco, looking at NET, NET, as well as Palo Alto Networks. So you own them or looking to buy them?
No, I don't own it. Just looking to buy either this one or, the other stock I mentioned to your screener is the Cloudflare.
Uh-huh.
I've been watching these two stocks. They both have pretty much kind of taken off in the recent months. My question to you is, which one do you consider as a stronger stock? And at what point do you think would be a good buy? Because I'm anticipating stock market will go down, right? In the next few months as the economy continues to kind of slow down. Just wanted to keep those on my radar.
Well, they're both pretty expensive, but if you are trying to decide which one's more expensive, that certainly is Cloudflare. You're talking about a price of sales at 36, which is extreme to say the least. The return on equity is negative. Their free cash flow is only $184 million on a $63 billion market cap. It's just in every possible way, it's egregiously overvalued. Okay. Now it's strong, but that's what you've seen lately is it's kind of a dash for trash, which I'll talk about a little bit later. Now, Palo Alto Networks, that one it's also expensive, but at least it's in the realm of reality. Okay. Its price of sales is 15 times. Okay. It's still expensive. It's it still has a nice profitability, 21% return equity, whereas Cloudflare is negative. Free cash flow is $3 billion on $128 billion market cap, which once again, not a great valuation there, but certainly in the ballpark. It's still in left field, but it's in the ballpark where Cloudflare is just way gone. So if I'm picking one or the other, I would definitely pick Palo Alto Networks, but I think that it has a lot of room to go down when there is a market pullback and the liquidity is ebbing. And I think we do get that environment over the next 18 months. Just simply, as I've said many times, the corporate bond refinancing cycle is starting to pick up. And that is a dynamic that not a lot of people are talking about, and is likely means that this will continue to be a year of big sell-offs and big rallies. And we already saw one big sell-off. I think we get another one in the back half of the year. Maybe that's a time to pick up Palo Alto Networks. Also what is your other portfolio? These are what we do on portfolio reviews is, how much tech do you have? We're overweight tech, but more small and mid cap tech versus the big mega cap, $100 billion companies or more. So I would be going down in size to look for better valuations within the tech space.
So, Justin, just so I'm clear, so do you have an entry point for Palo Alto Network for me to monitor?
Let me take a look here. In the low 100s, so about 50% below where it is today.
Okay. All right. Appreciate it. Thanks.
No problem.
Justin.
Thanks for the call. We're going to do a voicemail. Okay. We're going to do a voicemail real quick that came in earlier.
Hey guys, this is Rob from Chicago. Long-time listener. Obviously love the show and always appreciate all that you guys do. All the information is super great. I had a question today about Truist Financial, stock symbol TFC, banking sector. Just curious what your thoughts are overall and kind of the time of year. Just seeing if this is something for a little bit of a long-term hold. I'd say at least 3 to 5 years, if not longer. I'm in no rush, but just curious your thoughts on the stock symbol in general. And I look forward to hearing the answer on the podcast. Thanks so much.
All right, looking at TFC, which is Truist Financial. This is a combination of BB&T and SunTrust Bank. So it's a regional bank, mainly in the Southeast United States. I generally like that. The chart is starting to accelerate to the upside. I like that, which is a little bit odd to me. To me, this is market signaling there's a buyout here. I do think there's going to be a lot of consolidation within this space. And this is a relatively smaller name, $58 billion market cap. Earnings expectations for this year, next year are headed lower, but the stock recently has headed higher. So it doesn't really line up for me. This is probably telling me there's going to be some sort of a buyout here. Either they're going to buy out another bank or they're getting bought out themselves. I'm not sure. But I do like the earnings momentum here. The equity moment, stock momentum. And it's at a reasonable valuation. So Force earn $4.45 next year, 10 times earnings. I'm going to give this one overall a thumbs up. In the steepening yield curve is certainly good for the name and the sector as a whole. So I'm going to give Truist, TFC, a thumbs up.
This is Josh calling from the UK. Wanted to ask you a quick question about MP Materials. I own a small position now, a little bit less than 2% of my portfolio, but I was considering adding more, and I just wanted to kind of get your opinion on if you think that's a good idea and what a good price to get into would be. I appreciate your input. Bye.
All right, looking at MP Materials, and this is the largest domestic rare earth mining company. So really what you're doing here, this is all a geopolitical bet. That's all this is, because the company does not make money. And it's only supposed to make 4 cents per share next year after losing 62 cents this year. And it's a $32 stock. So there's no valuation use case here. This is all speculation that there will be a huge boom in rare earth mining here in the United States. And it is a geopolitical strategic imperative that we do that. That's your bet here. Now, I'm not going to argue against that bet, but it's a speculative bet. It's handicapping a Trump administration and a Chinese administration who are having ongoing negotiations. The recent quote unquote deal with China, it's really have to do with the rare earths, and it was only 6 months. So clearly, are they biding time for more development here domestically? Potentially. So that's what this looks like. Looks like the play here. It's kind of the only large publicly traded company that has any reasonable revenue, 60 million last quarter. But still, trading at 20 times sales. It's not cheap. It's not making money. There's no fundamental basis of owning the stock. There's only two things: geopolitical concerns and momentum. It's been an uptrend. Relative strength 96. So it's a pure momentum play. If you want to play it for that, great. But as a quote unquote long-term buy and hold investment, not with my money. Let's go with another YouTube comment question. And Jim Lay says, EQIX has been down big this week. You think it's a buy here, or are there better options elsewhere? EQIX. This is one of the first data center cloud computing plays that did very, very well over the last decade plus. Earnings in 2018 are funds from operation. This is a real estate investment trust. They build data centers. They've been doing it for a long time. And I think the question here is, are they getting crowded out? Right? There's them and Digital Realty. And they have experience, but other companies are getting into this space, and there's a big boom, and companies are bringing this in-house and doing it themselves because of the scale that's needed to run AI and all their cloud systems. Before, they heavily relied on Equinix, EQIX, and Digital Realty, etc. But this year, funds from operations is supposed to be up 8%, up 6% next year. So fairly slow growth. I think it's fine. I don't love it. You know, the valuation is not amazing. Price to sales is 8.6. Its payout ratio is very high. Let's take a look here. Its long-term debt continues to head to the upside. Shares outstanding, let's take a look here. That keeps going up as well. So to me, they're kind of on a unsustainable path with their dividend, which isn't that high, only 2.4% or so. Return equity is not that great. I just think there are better ways to play kind of the data center space, one that's more profitable, that isn't paying out a dividend, that's forcing them to leverage up their balance sheet. So I don't like that combination there. And so I'm going to pass on EQIX.
A little bit of a different question for you. Would just love your kind of personal opinion or philosophy on splurging on yourself. So we do a great job of kind of checking all the boxes. We max out our 401ks. We max out our Roth IRAs. We have our kids' college savings in place. We have a bridge account in place. So kind of check all the boxes and still have lucky enough to have some disposable income at the end. But I do personally have a hard time of getting out of the mentality of continuing to accumulate savings and things like that, and don't think we always spend enough on ourselves. So we just kind of love your philosophy or opinion on that and how you go about that, or recommend people to kind of change their mindset into actually spending some time. Thanks, and look forward to listening on the podcast.
I love this question because this is definitely an area where I've evolved throughout the years, and I've improved, I think, my ability to, and this is just my personal experience, to decipher good spending versus bad. And it's not just more is bad and less is good. It's not that clear cut. You know, I used to look for the bargains. You know, I used to buy into, oh, hey, we're getting a good deal on this, What I've learned throughout the years is that getting a good deal on something that you don't enjoy quite as much and you don't use very much at all, if ever, that's wasting money. But spending money on great experiences and a limited number of actual things that you know are of high quality, that you're going to use regularly, etc., spending more on those is a much better way to go. It's easy to get to buy into the hype of, I'm getting a deal on this, I'm saving this much, etc. What I focus more on is, what are the important things that I want to do with my money? Is that travel? Is that spend time with friends? Is that attend a certain event, a concert, a sporting event, etc.? And then select a small number of those things and splurge on them. And pay what is needed in order to have a quality experience. And you'll do much better and feel happier, at least I have, by doing a small amount of really cool things, great experiences with friends, versus just simply doing more by getting a good deal. For me, a good example is I've been on one cruise. I enjoyed myself, and those are great deals. But it wasn't really for me. I didn't really have the time that I was expecting, and it just didn't. It's not something I've had any urge to go do again. Even though, from a vacation standpoint, right, how much it costs per night and for food and all inclusive and places you get to see and travel, I think there's a great value there. And for some people, it aligns. It aligns with the things that they're looking to do, and they can do that with friends and family, and they have a great time on that. But it just wasn't for me. Okay. So that is the way that I think about spending. I think everybody should splurge on themselves to a degree, but do it in a way that fulfills you. Not that makes good social media posts. Not that the average person would think it's great, but what you think is great. What you personally, you and your family and friends, what you enjoy doing together. I think ultimately what we lack in this country, in this world, is more community, more connection, and finding avenues to get that, even if it costs you a little more money, is going to be a great way to spend your money and splurge on yourself and your loved ones. I'm Justin Klein. This completes another InvestTalk program. If today's show made you think about your own financial picture in any way, your asset allocation, sector allocation, we talked about, the passive flows, passive investments. This is a great time to rethink about that passive investment flow when things are good, when you might be overweight, those big tech names, and maybe a more active or equally weighted strategy would make sense. Maybe it's your taxes that you want to talk about, your retirement planning, etc. Well, I encourage you to head over to investtalk.com, click on the portfolio review button, and schedule a no-cost portfolio review with myself or Luke. And we thank you for listening to this podcast and radio show. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, and be sure to rate and review on iTunes as well. Independent thinking should success. This is InvestTalk. Good night.